The U.S. housing market in 2026 is not simply slowing down, it's gradually weakening. Cities that previously experienced intense bidding wars and home prices rising by as much as 40% are now seeing significant declines. High mortgage rates, expensive insurance, increasing HOA fees, and higher property taxes are making homes less affordable across the country. The market dynamics have shifted. Sellers who once controlled the market are now lowering their prices multiple times, and homes are remaining unsold for longer periods. Home equity is also decreasing, and this trend is not limited to a single area. It is affecting both expensive coastal cities and rapidly growing inland suburbs. In this video, we explored 10 U.S. cities experiencing the largest drops in home prices in 2026. These changes are measurable and are having real effects on local housing markets and economies. Whether you are planning to buy, sell, or invest in property, understanding these shifts is important. Follow along as we examine the housing market city by city. Let's begin with number 10, Boise, Idaho. If there's a city that clearly reflects the intensity of the housing boom during the pandemic, it's Boise. During that time, large numbers of remote workers moved into the area, bringing higher incomes and strong purchasing power. Comparative bidding quickly became common, and home prices rose sharply, increasing by more than 50% within just a few years. By 2026, however, the situation has changed dramatically. The rapid growth that once fueled the market has started to reverse, and the correction has been noticeable. Median home prices in Boise have dropped by around 20% from their peak. In some of the newer neighborhoods surrounding the city, the actual decline is even greater once builder discounts and incentives are factored in. Areas that once sold homes almost immediately are now experiencing a completely different reality. Developments that previously had buyers waiting in line now contain empty lots and completed houses that have remained unsold for months. The time required to sell a home has increased significantly, with many properties in the Boise area staying on the market for more than 70 days. Price cuts, which were once rare, have become much more common as sellers attempt to attract buyers. Home builders are especially relying on incentives to clear their inventory. Many are offering credits between $15,000 and $25,000, while others include 2-year mortgage rate reductions, upgraded appliances, or full coverage of closing costs to make their offers more appealing. Even with these incentives, buyer activity remains slower than expected. During the height of the housing boom, buyers worried about missing the opportunity to purchase a home. In 2026, that mindset has changed. Many potential buyers are now more concerned about overpaying. A key factor behind Boise's market correction is sustainability. Home prices increased much faster than local wages. As remote work growth slowed and technology hiring cooled across the country, the flow of high-income newcomers moving into the region also declined. Investors who entered the market aggressively between 2020 and 2022 are now feeling pressure. Some owe more on their properties than they are currently worth, while others are holding homes with very small profit margins. At the same time, rental vacancies have begun to rise, and demand for short-term rentals has weakened. As a result, the income projections that once supported high property prices are no longer as convincing. Overall, the mood of the market has clearly shifted. Buyers are acting more cautiously, while sellers are gradually adjusting their expectations. Boise still has strong geographic appeal and offers a high quality of life. But when it comes to housing prices, the market is still searching for its true bottom. Number 9. Miami, Florida. Miami's skyline still shines brightly at night. Luxury cars continue to move through its streets, and the city's beautiful ocean views remain as captivating as ever. On the surface, Miami still appears to be the same glamorous real estate destination. However, beneath that polished image, the housing market is starting to show clear signs of pressure in 2026. Across Miami-Dade County, median home prices have declined by nearly 14% from their highest levels. In the luxury condominium market, the adjustments have been even more noticeable. Price reductions of 20 to 25% in high-end towers are becoming increasingly common. Condos that once sold out during the pre-construction stage, often with long waiting lists of buyers, are now completed, fully furnished, and still waiting for offers, sometimes at discounted prices. One major factor behind this shift is the rapidly rising cost of insurance. In many high-risk areas, homeowners are now paying annual insurance premiums ranging from $10,000 to $15,000 for single-family homes. Some insurance companies have even withdrawn from the market entirely, forcing homeowners to depend on state-backed insurance programs that typically come with higher deductibles and fewer benefits. At the same time, updated hurricane risk models and newly revised flood zone maps have increased concerns about property ownership in certain areas. These changes have made some buyers more cautious about purchasing homes in the region. Affordability is another growing challenge. When median household income is compared with the average home price, Miami consistently ranks among the least affordable large cities in the United States. With mortgage rates close to 7%, the monthly cost of owning a home has risen far beyond what many local buyers can comfortably afford. Investor activity is also beginning to slow. The strong wave of investment that once fueled Miami's housing boom is gradually easing. Profits from short-term rentals have tightened, leaving many property owners earning less than they originally expected. Meanwhile, condominium association fees have increased as buildings struggle with rising insurance costs and higher maintenance expenses. Another change involves international buyers. The large amount of foreign investment that once flowed into Miami's real estate market has slowed compared with the peak years. As a result, the overall market dynamic is shifting. More homes are being listed for sale, properties are remaining on the market longer, and sellers are negotiating far more often than before. For the first time in years, the sense of urgency has reversed. Instead of buyers rushing to secure properties, many homeowners are now the ones feeling the pressure. Number 8. San Francisco, California. During the technology-driven housing boom of the past decade, few real estate markets rose as quickly or as dramatically as San Francisco. The city benefited from soaring tech salaries, wealth generated from major IPOs, and strong investor confidence. By 2026, however, this once red-hot market is experiencing one of the most noticeable corrections in the country. Home prices across San Francisco have declined by about 17% from their peak. In certain areas, particularly in the condominium sector, the drop is even more significant. When seller incentives, buyer credits, and negotiated concessions are included, some condo segments are seeing effective price reductions closer to 25 to 30%. High-rise residential towers that once commanded extremely high prices are now facing a different environment. Vacancy levels in several buildings have increased, and listings are taking much longer to attract serious buyers. One major factor driving this change is the long-term impact of remote work. Although the Bay Area remains one of the world's most important technology hubs, the rise of hybrid and fully remote jobs has changed how professionals think about where they need to live. Many workers no longer feel the same need to remain close to downtown offices. At the same time, San Francisco's commercial real estate sector has been dealing with high office vacancy rates. The slowdown in the business district has also affected the residential market, weakening some of the demand that once pushed prices upward. Layoffs in the technology industry over the past 2 years have added further pressure. As major companies reduce their workforce, the number of high-income buyers has declined. Even those who still hold stable tech jobs are approaching large purchases much more cautiously than they did during the boom years. The overall cost of owning property in the city has also continued to rise. High property taxes, increasing HOA fees, required building upgrades, and higher insurance costs have all added additional financial strain for potential buyers. Housing inventory has gradually increased, which means homes are remaining on the market longer. It has also become common for sellers to reduce their asking prices several times before finally reaching a deal. Luxury condominiums that once sparked intense bidding wars are now competing heavily on price simply to attract interest. San Francisco still holds enormous cultural and economic importance. The famous views of the Golden Gate Bridge remain iconic, and the region continues to be a global center for technology and innovation. However, by 2026, the city's housing market appears to be going through a deeper structural adjustment rather than just a temporary slowdown. The correction is clear, the numbers confirm it, and the market is still in the process of finding its new balance. Number 7. Tampa, Florida. Not long ago, Tampa was considered one of the hottest housing markets in the United States. This Gulf Coast city saw a large wave of new residents moving in from across the country. Investors also rushed into the market, hoping to benefit from the rapid growth. As a result, home prices increased at double-digit rates year after year, creating one of the most intense housing booms in the nation. By 2026, however, the atmosphere in Tampa's housing market has changed noticeably. Median home prices have dropped by nearly 11% from their recent peaks, indicating a clear shift in market conditions. At the same time, the number of homes available for sale has increased sharply. In several parts of the metropolitan area, housing inventory has risen by more than 60% compared with the previous year. Neighborhoods that once saw homes sell within 48 hours, often with multiple competing offers, are now experiencing a much slower pace. Many properties remain on the market for 75 to 90 days before finding a buyer. Sellers who previously expected bidding wars are now facing a different reality. Instead of reviewing several offers, many are reducing their asking price 2 or 3 times before attracting serious interest. Insurance costs have become one of the biggest pressures affecting the market. Flood insurance premiums have increased significantly, rising between 35 and 45% in some areas. Hurricane deductibles are also growing, adding another layer of financial risk for homeowners. In certain cases, private insurance companies have reduced or withdrawn coverage entirely, forcing some homeowners to rely on state-supported insurance programs that often carry higher premiums and less favorable conditions. When these rising insurance expenses are combined with mortgage rates close to 7% and increasing property taxes, the monthly cost of owning a home looks very different from what it did just a few years ago. Investors who once played a major role in Tampa's rapid expansion are beginning to step back as well. Income from short-term rentals has weakened in several areas, especially in neighborhoods heavily filled with vacation rentals near beaches and entertainment districts. For property owners who purchased homes at peak prices, the financial outlook is becoming less attractive. In many situations, rental income is no longer enough to comfortably cover mortgage payments, insurance, property taxes, and maintenance expenses. Some investors have even started listing their properties for sale at prices lower than what they originally paid, simply to limit their financial risk. Although the overall Tampa economy continues to show signs of strength, the housing market itself is clearly going through a period of adjustment and recalibration. Number 6. Phoenix, Arizona. During the housing boom, Phoenix became a clear example of rapid growth and continuous expansion. Large master-planned communities kept spreading deeper into the desert, construction cranes were visible across the city, and investors entered the market aggressively. By 2026, however, this same market is experiencing one of the most noticeable slowdowns in the Southwest. Home prices in the Phoenix area have dropped by about 13% compared to the peak reached in 2022. In some of the outer suburban neighborhoods, the decline is even greater. When builder incentives and discounts are considered, the effective price decrease in certain areas is closer to 15%. Homes are also taking much longer to sell than they once did. In many parts of the metropolitan area, properties now remain on the market for more than 70 days on average. Houses that previously sold almost immediately are now waiting months before attracting a buyer. One of the main reasons for this shift is overbuilding. During the height of demand, developers significantly accelerated construction, expecting the surge of buyers to continue. However, demand has cooled, and the market has not absorbed the large supply of new homes as quickly as anticipated. As a result, both resale properties and newly built homes are entering the market at the same time, giving buyers far more options. With increased supply, buyers now have stronger negotiating power than they did during the boom years. Price reductions are becoming increasingly common. In many mid-range suburban communities, sellers are cutting prices by $20,000 to $40,000 in order to remain competitive. Large institutional investors are also adjusting their approach. Many companies that previously purchased single-family homes in bulk to convert into rental properties are now reviewing their portfolios more carefully. Some have already begun selling homes with smaller profit margins to reduce their overall risk. This additional supply further adds pressure on home prices. Affordability has also become a significant challenge. With mortgage rates around 7%, monthly payments for a typical Phoenix home are much higher than they were in 2021. On top of that, homeowners are dealing with rising utility costs, concerns about long-term water availability, and increasing insurance premiums, all of which raise the overall cost of owning a home. The result is a market where buyer enthusiasm has cooled considerably, and sellers are adjusting to a much more cautious environment. Number 5. Austin, Texas. Over the past few years, only a handful of cities experienced a housing boom as intense as Austin's. The city's thriving tech industry, the growth of remote work, and its strong cultural appeal combined to drive demand to extremely high levels. As buyers poured into the market, home prices rose quickly, increasing by more than 40% between 2020 and the market's peak. By 2026, however, that rapid rise has clearly begun to reverse. Median home prices in the Austin area have fallen by about 14% from their highest point. In the downtown condominium market, the decline has been even more noticeable. Some units in high-rise buildings are now being listed with discounts ranging from 20% to 25%. Even with these price cuts, certain condos are still taking longer to sell. At the same time, the supply of homes across the metropolitan area has grown significantly. Compared to the extremely limited inventory during the boom years, the number of homes available has increased by more than 65%. Developments in the technology sector are also influencing buyer behavior. Slower hiring, layoffs, and restructuring at major tech companies have made many potential buyers more cautious. People who once rushed to compete for homes are now waiting to see if prices might decline further before making a purchase. This change is also visible in Austin's rapidly growing suburbs. In newer development areas, newly constructed homes are now competing directly with existing resale properties. To maintain sales momentum, builders are offering strong incentives, such as mortgage rate reductions, credits toward closing costs, and upgraded design features to attract buyers. Despite these incentives, homes are not selling as quickly as they once did. The pace at which available homes are being purchased has slowed noticeably compared with the peak demand years. Another factor affecting affordability is Texas's property tax system. Property taxes remain a major expense for homeowners in the state. When these taxes are combined with today's higher mortgage rates, the monthly cost of owning a typical home has risen to levels that challenge the budgets of many households. Austin continues to be one of the most vibrant cities in the country, both economically and culturally. However, by 2026, its housing market presents a very different picture from the rapid growth seen just a few years earlier. Number 4. San Diego, California. For a long time, San Diego looked almost immune to housing downturns. The region benefits from a powerful mix of economic drivers, major military installations, a rapidly growing biotech sector, thriving tech startups, and some of the most desirable weather anywhere in the United States. Those factors helped create steady, almost relentless demand for housing year after year. Yet, in 2026, even San Diego's housing market is beginning to show clear signs of softening. Median home prices across the area have slipped by nearly 10% compared to the previous year. Certain parts of the condo market have seen even steeper adjustments once seller incentives and concessions are factored in. Effective price corrections in some condo segments are closer to 15%. Neighborhoods that previously sparked bidding wars within just a few days are now experiencing a much slower pace. In many areas, homes are remaining on the market for 60 to 75 days before serious offers appear. One factor contributing to this shift is the growing saturation of short-term rentals. During the boom years, investors rushed into the market, purchasing properties with the expectation of strong vacation rental income. But conditions have changed. As local regulations tightened and tourism demand returned to more normal levels, occupancy rates began to slip. The strong nightly rental rates that many owners once depended on have become harder to maintain, shrinking profit margins. At the same time, operating costs continue to climb. Insurance premiums have risen sharply in areas located near wildfire-prone zones. In some cases, annual insurance costs are now reaching between $8,000 and $10,000 for certain properties. When those rising insurance expenses are combined with higher property taxes and mortgage rates hovering around 7%, the total monthly cost of owning a home has become far more difficult for many buyers to manage. Even the luxury segment along the coast is starting to feel the pressure. High-end homes near some of San Diego's most popular beach districts, properties that once attracted immediate interest, are now seeing price reductions and negotiated sales below their original listing prices. San Diego still holds strong long-term economic advantages, but 2026 is clearly shaping up to be a period of adjustment for its housing market. Number 3. Las Vegas, Nevada. Las Vegas has long been known for its dramatic swings in the housing market. The city saw a strong surge during the boom, but by 2026, the momentum has shifted and the market is now experiencing a significant correction. Home values have declined by roughly 15% compared with their 2022 peak. Foreclosure activity has also started to rise, still relatively low by historical standards, but noticeably higher than the unusually quiet levels seen during the peak years. During the height of the boom, investors flocked to Las Vegas, especially targeting single-family homes in growing suburbs like Henderson and North Las Vegas. Many of these investors relied on strong rental demand and ongoing price appreciation to make their investments profitable. However, as borrowing costs increased and rental growth slowed, those profit calculations changed. Profit margins tightened, and some investors are now selling properties at reduced prices rather than risk holding them through further declines. Another challenge for homeowners is the rising cost of utilities. Las Vegas has been experiencing increasingly intense heat waves, and during peak summer months, electricity bills for larger homes can exceed $400 to $500 per month. Combined with water restrictions and rising HOA fees in many master-planned communities, the overall cost of owning a home has grown significantly. At the same time, housing supply has steadily increased. Properties that once sold in less than 10 days during peak demand are now taking much longer to sell, often remaining on the market for 60 to 75 days before serious offers appear. To attract buyers, sellers are frequently offering incentives such as mortgage rate reductions, credits toward closing costs, and upgraded design features to attract buyers. Home builders are responding to the slowdown by delaying or scaling back new construction phases as demand softens and absorption rates decline. While Las Vegas continues to see strong tourism, the residential real estate market no longer benefits from the same level of migration and speculative buying that fueled the earlier boom. Number 2. Denver, Colorado. Denver has long been celebrated for its combination of urban opportunities and easy access to the outdoors. Over the past decade, Denver attracted remote workers, tech professionals, and high-income newcomers seeking modern living with scenic mountain views. But by 2026, Denver's housing market is showing clear signs of stress. Median home prices have declined by about 12% from their peak, and condo inventory in some downtown neighborhoods has increased significantly. In suburban areas such as Aurora and Lakewood, homes are now often staying on the market for 60 to 75 days, a sharp contrast to the rapid sales seen just a few years ago. Affordability lies at the core of this slowdown. Rapid price growth during the boom pushed home values far beyond what local wages could support. With mortgage rates around 7%, the monthly cost of owning a median-priced home has risen hundreds of dollars compared to 2021. Other expenses have added to the strain. Insurance premiums have risen in wildfire-prone zones, and HOA fees in newer condominium developments are climbing as maintenance and construction costs increase. Builders and developers are now relying on incentives such as prepaid HOA fees or mortgage rate reductions to encourage buyers. The rental market is also cooling. Vacancy rates in certain downtown corridors are rising, and some higher-income renters are choosing flexibility, waiting to see if further price adjustments make long-term ownership more appealing. Despite these challenges, Denver's economy remains strong and diverse, and the city continues to be attractive over the long term. Still, in 2026, the housing market is clearly in a pullback phase, with inventory growing, more cautious buyers, and noticeable declines in home values shaping the landscape. Number 1. Atlanta, Georgia. Over the past few years, Atlanta became one of the clearest examples of America's housing boom. Remote workers moving from expensive coastal cities, investors seeking rental income, and families looking for relatively affordable homes all converged on the metro area. Demand soared, home prices rose rapidly, and new subdivisions expanded outward as inventory dropped to historic lows. By 2026, though, that momentum has shifted, and the market is now experiencing a significant correction. Home values have declined by roughly 12% compared to their recent highs. In some mid-tier suburban communities, effective declines are even steeper once seller concessions and incentives are factored in. Effective price corrections in some condo segments are closer to 15%. Neighborhoods that previously sparked bidding wars within just a few days are now experiencing a much slower pace. In many areas, homes are remaining on the market for 60 to 75 days before serious offers appear. One factor contributing to this shift is the growing saturation of short-term rentals. During the boom years, investors rushed into the market, purchasing properties with the expectation of strong vacation rental income. But conditions have changed. As local regulations tightened and tourism demand returned to more normal levels, occupancy rates began to slip. The strong nightly rental rates that many owners once depended on